Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you a strategy of the day update here. We're going to focus on our row crops. Had a bit of a disappointing end of the day there, where we gave back the gains from post open, where we didn't really even go positive on the day. So that being a technical development, kind of leaving a bearish tone to the row crops into the close, suggests that tomorrow we might see a little bit more follow through to the downside that they didn't get today. But we'll see what the charts and what some of the technicals are looking at now. So let's begin actually by taking a quick look at weather over the last week, because we are, through our last WASDE report. We're coming into WASDE report a week from this Friday on the 12th. Temperature forecasts across the U.S. have dropped, a little bit than, from where we were, but we are still expecting hotter than average temperatures everywhere. Maximum temps in most of our corn belts are staying in the low 90s, with the exception of a couple days there that might get towards 100. Generally speaking, if with the soil moisture content we've seen over the last 2 weeks, should be enough to carry us through a little bit of heat, and with maybe a probability for rain, but a little bit behind there in the 14-day. We'll see here in a second. Could see a weather event propping up here and possibly beginning. We've got some good jet streams taking warm, moist air up from the Gulf here, which just needs cold fronts to move through to turn it into rain across the Midwest. There isn't much on the radar for, from Nebraska through Illinois that hasn't already dropped. There's looks like some storms and what will be some scattered showers moving across North Dakota and northern Minnesota there, but generally speaking, not much on the radar. 6 to 10 day forecast here for below to somewhat average rainfall, which is certainly a change from where we were 2 weeks ago, where these forecasts were all above normal precipitation. And the 8 to 14 day precipitation outlook still saying and remaining below here for the first 2 weeks of August. Again, creating a bit of a weather event, which was probably giving us some support on the markets today, but obviously trading a little bit of that Taiwanese news with Pelosi landing and making more of an enemy with China could be disruptive to trade. We have yet to see how Beijing will react. Again, those temperature outlooks are still above normal temps for the first 2 weeks of August, but we're certainly doesn't look like we're going to get to extreme temperatures. This last week, we saw some scattered rainfall across the Midwest, getting us, on average, 1 to 3 inches in many places. That was, pretty good to see. And the week before that, we got, additional rains that also helped. So we're through the weather event that caused, I think, the drop in price that and certainly the more bearish tone that we've seen. And now we're left with a market that is trying to decide and discover price here into a WASDE report for the following Friday. Beans closing down 19.5 cents there in November. Not a great finish for the day. We're down 25 cents there in front month August. Old crop, new crop bean spread widening out a little bit further there. And actually, I think getting close to that dollar or $2 over, rather. We were $2 over at one point today. So we're seeing bull spreading here with the exception of today, but a bull trend here in the calendar spreads for old new crop. But we really haven't seen that bullish tone take the underlying higher at this point. So kind of an interesting thing. August-December corn, or September-December corn I've got here, is trading at 3 cents under, so we've gone below even money. Full carry on this type of spread is down, well south of 40 cents under, so there's plenty of room to build carry into this market if it wants to. But we are oversold on the spread at this point, and we'll take a look at where support has been holding for corn and see if that doesn't translate into a technical trade at this point. It's interesting because the technicals are saying one thing, the fundamentals have been kind of ignored. And on a day like today, it was actually surprising to a trader like me to see corn as heavy as it was relative to beans and wheat, at least. But then again, the last 2 days, corn has held up better than beans had. And maybe it was playing a little bit of catch up today. September corn finishing down 15.75 cents, with December down 15.5. Let's begin with this chart of December corn. This is a daily chart. The 200-day moving average has been our formidable resistance on our last test up there on Friday into the 620 area. 623.25 is where the current level is, and it seems like we just pulled back today off that 200-day moving average down into that 19-day moving average, which is usually a very good indicator, or 18-day moving average in this chart, that red line, which is usually a good short-term trend indicator. Bullish above, bearish below. When we really do set up in a solid bull trend or bear trend, that 18-day moving average tends to be a good intraday level to watch. We did close back below it here today, and it being at $6, big psychological level at this point. We'll look at also why that $6 mark might be technically a technical supportive area that we should pay attention to. The only problem I have here with this chart is this gap we've left open at 582. We could be hunting for the market to fill that gap in the near term. We did get overbought there in the stochastic RSI into the end of July and into last week, but we've unwound that overbought condition. So if the market wanted to pick itself up by its bootstraps here and start a little bit of a bull trend higher up towards that 55-day cluster of 55-day and 100-day moving average with the 100-day at 682 and the 55-day at 665, I wouldn't be surprised to see a move up there. But it's way too soon, I think, to be calling for moves back above $7 for corn, not without, a prolonged weather event here, pickup in exports, or I don't know, maybe the USDA comes out and cuts corn, yields by 2 to 3 points, and does nothing with exports at that time, because we are unfortunately considering that in our next WASDE report a week from this Friday, any kind of reduction in yields that we see from corn or beans might be offset by reductions in export numbers and in demand. USDA has a high probability of doing that kind of thing to keep the balance sheet rather unchanged and just be playing with the numbers until they can't anymore. But it is what it is. So trendline support here against the lows, which is this kind of yellow line. We're still flirting with trying to stay above it. If you were to draw it through, it's somewhere around the 590 area. It's not exact science, but just knowing that, hey, any trend line that the contract has held up to this point, we're still fighting to try to stay above. We are still staying above, though, that old breakout area from the 530 to 550 area that was the resistance June through December of last year. We started a rally off this for 2022. We've unwound that rally. We're holding that old resistance as support still, but that doesn't mean intraday we couldn't revisit those levels down even as low as 560 here on this chart. Another important level to consider here, that 560 area, and why is still an important level that I like to talk about. From contract lows to contract highs on December corn, 567 3/4 is a full 50% retracement of the entire rally from the 2020 low in June through the 2022 high of 760. So market 2 steps forward, 1 step back, broken support resistance, or broken resistance now support. All good reasons to say 560 could be the area, the low-hanging fruit for corn, and so the major support that we're holding. But certainly the two reactions we've had off this level that took us to above 650 2 weeks ago and above 630 here on Friday haven't been enough to get things going. So let's break down the smaller time frame chart here for December corn and see what else we can kind of determine in the near term from our intraday price action. So 4-hour chart here up for December corn. We got open gaps at 730.5 way above us, 673 at 80 from the end of June there. There is also an open gap on this chart down here at 582. That level could be, where we're hunting down to in the near term. The full 50% retracement from the 560-175 highs to the 636 lows to highs, came in around 599. I think it's the area we saw support there yesterday for a little bit of a rally off that level, but then overnight we gapped back down and have sold off since then. Bull markets don't usually like to fill gaps, so I'd want to see corn pretty much stay above 590 at this point, but can't rule out that move down to 582 in the near term, or even a revisit of that much larger, 567, 50% level to pay attention to. This old cluster of highs and lows, between 631 to 645, it was resistance. We broke through it. It was support. It then was support on the first time back down here. We broke support there. We came up and are now finding that area as resistance. So to the upside, the 640 to 650 area is certainly some kind of resistance that this market may want to or have some trouble chewing through, as we've seen. But to the downside, we have some pretty major support at 560, giving us about $1 range for December corn at this point. And inside of that range, we have transversed it 1, 2, 3, and now the 4th time up and down. So this is a range to me until it's not. I was getting rather bullish here on that move back above $6 today. Seems like it was a little early because they took it down to the lows into the close. So if we don't see, an immediate bid and a reversal tonight, this could get a little hairy. And again, 582, the first level to the downside I'm interested in. Then after that, it's just a retest of 560, in my opinion. We'll see. We'll see how that trades out and holds. November beans. Went out the day down 19.5 cents here at 1386.5. That is $1 off the highs from last Friday. Yesterday being a pretty big, it wasn't engulfing because we didn't make a new high, but yesterday was a pretty big sweeping reversal day. The 55 and 100-day moving averages around 1455 and 1467 are clear resistance that this chart has held. We came back down for a test of the 200-day and the 18-day moving averages here, respectively, at 1390 and 1372. So, okay, beans also with a pullback. Got a little overbought there with the stochastic RSI, has now unwound that overbought condition. And now, we seem to be caught in this range between these moving averages, the 155-day and the 219-day. Whether or not either one of these holds is remained to be seen, but beans did also have also now traded into a 50% pullback, something worth noting that we'll look at in a minute. The old resistance here going into the end of the year in the $12.70 to $13 area, we broke through it. We've come down, unwound all of 22's gains, holding $13, much like that 560 area is like $13 here in the beans. It's kind of an equivalent technical level to pay attention to. And nothing, we can't rule out, a move all the way back down there either. But we do have some support on the bean chart that I'm cautiously optimistic here is still kind of trading and holding. And we'll look at that 4-hour chart now. I've got an hourly chart up, but nevertheless. 1584.75 highs from the month of June down to the lows here at about 1287. That 50% retracement didn't hold. We went up to 61.8 lines all the way up to the 65% line around 1481. To me, that is a technical break. Now, this doesn't necessarily mean, if we get down to 1360 or down to fill this gap at 1350, which, by the way, there is another open gap on this chart down here at 1350. That we could be heading down to, just like with December corn at 582, 1350 for the beans could be, an area that we're trying to get down to fill. Move this drawing real quick. But the idea here is that in my branch of technical trading, when I see a 61.8 line break in one direction, I immediately draw up the 50% in the opposing direction. So from 1288 lows to the highs after, creates this 50% level at 1388. Saw some reaction from it here today, and it's been clearly, the support on the chart that we're trying to hold, right? It's old resistance here too that we were trading a few days ago at 1390. Now a support. We've come back down to that level. Okay, makes sense technically as to why there'd be some buyers here and some support. However, the stops below 1380 at this point don't seem safe, and we might be heading to 1350 for a gap fill. Now, if we do go down to that gap fill, beans will have broken 61.8 lines on both sides for longs and shorts, and that to me suggests a much larger range is at play. And between $13 and $15, that $2 range will probably stick for a time being, and remain a range on this chart until it's not. But with all that being said, neither corn nor beans have really broken this technical long area, or this 2 steps forward we took from last 2 Fridays ago, and now 1 step back we've taken since last Friday, suggests that if we do hold, relatively soon or within a few pennies of where we are, this market could be a technical, buy. It's just tough this time of year when weather markets are, at the forefront of news, and we seem to be very range bound at this time. So I'm a little more conservative today with that close. If we had closed above 14 and above 6 in beans and corn respectively, I'd be a little bit more bullish than I am now, but it is what it is. Our wheat charts look pretty awful and look like they're entrenched in a downtrend with below the 55-day, 100-day, and 200-day moving averages, and even below that 18-day moving average and holding it as resistance here. Chicago wheat in the September contract traded down 25.5 cents today, finished at 774 3/4. We got to take a really big step back on these charts to see where wheat could go. But unfortunately, below the 750 area, we open the door below 700 and start to get back to areas on the September wheat we really haven't even been liquid at. But this 18-day moving average holding as resistance still in, I believe, in all three wheat products. Yeah, here's the KC wheat. It's below 868, and the spring wheat below 917 suggests that we are, kind of entrenched in a bit of a downtrend still. And wheat is, in its own world doing its own thing right now. We'll see if that can, kind of continues here. Bean oil, real quick, I wanted to point out that we actually pulled into a full 50% retracement from this almost 66 high down to lows now. Let's try drawing that again. There we go. That 50% level here around 60. Seems like an interesting area to be a buyer. It's old resistance here from the last 2 weeks. Pulled back, trading it now as support, and dragging that 18-day moving average up almost to 60. Suggests that maybe bean oil is trying to lead the bean complex off the lows. But again, we need to see support prove itself here into 60. Outright beans need to also kind of get their act together. And also, we would probably want to see a little bit more of a sustained rally in crude oil. Crude has certainly put a footing in here above the 90 figure, but we're caught in a $10 range between 90 and 100 at this time. The market doesn't seem very, confident to want to, break out and go higher, even though this could be a completed three-wave correction off the highs. I can't rule out one more leg lower towards 86 that, in my opinion, would clean this chart up and make for a more formidable level to bounce from. That'd be the 100% extension from 130 measured to 92, extend it from its 123 high here. All things being equal, 86 would be equal legs down. It would also be a, stepping out to the daily chart for crude here, also be a test of this major trend line that we've been trading in crude here since May of 2020. So almost like to see one more move lower for crude, but if we do base above 90, we start to get a rally going for the crude oil. Soy oil should follow, corn should follow, and an energy rally would otherwise just help out our row crops at this time. Okay, and last but not least here today, feeder cattle and fats. The feeder cattle in the August contract still holding its next in the series from 169 up to the 181 highs. We've been in this range between 181 and 176. Pretty much the same looking feeder chart no matter what month you look at. Just add in, the premium between them. We break below 174. That would be, to me, a trend break of this rally that we've had since mid-May. And we'd probably be revisiting those May lows if we get below 174. That'd be a break of the trend line against the lows at the highs. It'd be a break of the next in the series long here. And I am a little worried that this 176 area, 175 to 176, is now a head and shoulders pattern. Left shoulder here, right shoulder here that was formed today and yesterday, and the head there forming last week. So again, below 175 to 176, 174, we start to break down. I'm watching those levels pretty closely now because of that. Now, in the rally we saw in the feeders, always and typically being the leaders, fat cattle did not follow through and could barely make a new high above June's high here in the July candle. August has been spent basically sideways in this range from 141 to 143, and without a nice breakout higher, which I think could take you, all the way back up to 146 and above for a retest of contract highs, and certainly to fill this gap that we've left on all the feeder fat cattle charts up around the 146 area in the October. Very similarly to feeders, though, we have a upward sloping trend line that kind of comes, I'll call it 140, 150 at this time. We get below that low, we're probably retracing the month of July's price action. Revisiting those lows at 137 is just a short cry away from the lows of May at 135. And this rally here just looks like it's lost steam to me. I would have expected us to have pushed up to 144 and above following the feeders in the last move we've seen, but a seasonal slowdown for the cattle complex is to be expected right now. And if recession fears coupled with inflation are starting to cause people to pinch their pennies a little bit more, beef prices are sure to come down, and that's only going to put strain on our cattle production at these high prices. So there's only one way, in my opinion, that cattle can go, and that's probably lower here. We just need to get a break on the technical side to, I think, really see things accelerate lower. All right, well, that concludes today's Strategy of the Day recap. My name is Dan Hussey with Zaner Ag Hedge. Join me every Thursday at 2 p.m. Central, where I host the Strategy of the Week webinar. Sign-up links in the information and comments section of this video. You can also sign up for our free Zaner Daily newsletter, where you can get upbeat information on what's going on in the markets from our team. It's free to join, and the sign-up links are also included. Have a great day, everybody, and we will be back with you as price action develops. Take care, everyone.